This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Welcome, my name's Patrick Malcolm. We're here for another GFM Wealth podcast. I'm joined by Campbell McComb from EP12 today. Thank you for joining us, Campbell.
Thanks for having me.
That's good. Now, just to start with, before we start talking about investments, we're both long-suffering Carlton supporters.
We are, unfortunately. Yeah, it's been an interesting start to the season. I must say both of my long-suffering children, and the third one's given up a long time ago, but my two elder children both had their head in their hands watching a victory over the Tigers.
Yes, I took my son along and we had the same experience. And now I'm sure there's lots of Collingwood and Richmond and Essendon supporters and Swan supporters laughing at us while we talk about this stuff.
Yes, well, your colleague will be the first to do so, I would imagine.
All of my colleagues. So just to start with, for those of our listeners that don't know EP12, can you give us a quick overview of what your business does?
Yeah, sure. We set EP12 up about 7 years ago now with a view of offering sort of truly differentiated private markets investments to high net worths, family offices, and those kind of investors. I think the way that we sort of look at the continuum, I guess, if you like, there's venture capital at one end of the market, there's the large end PE at the other end of the market. Mm-hmm. We sort of sit in the middle piece in what we call expansion capital. Yep. So we'll go in both domestically and in the US. And if you look at the domestic piece, we'll go into sort of that expansion phase investments with things like pet stock and luxury escapes and the memo, which we've done domestically here. And then in the US, we'll pool funds together with 3 to 6 investments directly to give a bit of diversification, but still be very concentrated in that exposure to the investment. So generally just offering unit trusts that have that sort of 3 to 5 year kind of lifetime with a view of getting money back to investors during that period.
I guess personally, how did you end up in private markets? And then from there, what motivated you to start EP12?
Yeah, look, I think if I look back on my career, 20 years as an Australian equities manager, I think the long and the short of it is I got bored with what was available in the equity markets. Yes. It's
certainly not in Australia with all the banks and resource stocks and supermarkets.
Exactly. Yeah, go short Rio, long BHP. Yeah. But I think that ability to access interesting markets, but also, I think more importantly, probably be more involved in the growth of the underlying businesses. Mm-hmm. So when we get involved with a business, either ourselves or our co-partners over in the US sit on the board of these businesses, add value as they continue to grow. For example, I'm on the board of Luxury Escapes. I know every day from an information flow perspective, what their sales were, what their margin was, which products are selling, et cetera, et cetera. So having that active involvement, and the other part of it is, I think, is a more long-term approach to investing. Yep. So I think markets have gotten very, very short-term focused. And my concern with that is they're worried about the next earnings call or the next sort of piece of information that comes out, as opposed to managing businesses for a 3-year, 5-year long-term horizon.
Yeah, and I guess the ability, like being on the board, is the ability to move the dial and influence decisions in that company, which is really difficult with listed companies, particularly big listed companies.
Yeah, I mean, there is an asymmetry of information when you're talking about listed companies. You don't have access to information until everyone has access to the information, whereas with our businesses, whether it's Luxury Escapes or the groups in the US, we know months in advance of what's going on, and you have the capacity to hopefully turn the ship a little bit if you're headed towards the iceberg, you turn right? Yep. It's that ability to try and change and mould the future of the business. Now, we're not going to sit here and say, okay, we know how to run an OTA better than Adam Schwab.
Yep.
But at the same point in time, I think that capacity to be involved and actively involved in the underlying businesses is crucial from our perspective, and we love it.
Yep, interesting. Now, jumping to private equity as an asset class, I think it could be described as being a little bit behind the curtain, maybe a jungle. Campbell.
We prefer not to use
No,
those
that's okay.
kind of phrases, but yes.
But for someone that's not familiar with the asset class, Campbell, could you maybe give us an introduction, the elevator pitch about private equity and why it's attractive as an asset class?
Look, the really simple way of looking at it is it's exactly the same as a listed company.
Mm-hmm.
Like we're investing in companies. We're looking at the prospects of the companies, the return profiles, what kind of income growth, whatever it happens to be that you're looking for to come out of those businesses. It's just generally in the private equity sphere, and there are differing forms of private equity, as I mentioned before. Yes. If you look at the large end, they're buying whole companies and leveraging them up and looking to turn them out over a 3, maybe a 5-year time frame.
Yep.
What we do is we buy meaningful minorities, so 10 to 40% of businesses work directly with founders and have the capacity, as I said before, to be involved in decision making. But we want the founders to continue to be involved in the business because they're the ones that have brought it together and done all the hard yards to get to the point where we're investing. And we are truly in that sort of that middle phase of private equity. We're not going early where the VCs are, where there's a risk of obviously going broke. We sort of wait until there's product acceptance, market acceptance, generating revenue, maybe as far as the US companies go, getting non-dilutive government grants, etc., and then sort of hopefully building them up to the point where we maybe hand them over to the big end PE. And we do tend to look at how we get out of things when we go into things, if that makes sense. So we're walking into the proverbial room and we love to see 3 doors in that room. Like one's an IPO, one's a trade sale, and maybe one's a merger with a view of coming to market at a latter stage kind of thing. So leveraging those exit opportunities because that's what's going to give you the best return at the end of the day.
And obviously the return potential when you're dealing with the private equity space relative to public markets because of all the things we spoke about before, Campbell, is obviously greater.
Look, and I mean the 2 trade-offs, I guess, are liquidity.
Of course.
And return. So if you're giving up liquidity, which in our case you are, you're locked in for 5 years, call it, you should have an expectation of a high return. And private equity, if we do the rough sums, has probably outperformed the MSCI World Index by 4 or 5% over the last 25 years.
Which is significant when you compound it out.
And I think that's where it becomes an important component of people's portfolios, not trying to do your job for you. But at the same point in time, it's not ever going to be the major component of people's portfolios. It's designed to be that 10 to 20% maybe of people's portfolios that, provides that little bit extra return. And sometimes I think from an end investor perspective, being locked up is not a bad thing.
No.
I think it stops decision making.
Selling at the worst possible times and all those sorts of things.
Exactly. So I think from that perspective, it certainly provides part of a portfolio and a broad portfolio.
I think the distinction you make around different types of private equity is really important. Often when you chat to people the first time about private equity, they have this perception of the barbarians at the gate that buy 100% of a business, sack a whole heap of people, lever the thing up and then flick it onto unsuspecting retail investors down the line. That's certainly not the space that you guys are dealing in.
Not the space that we're in. There's plenty of them around. Our model is, as I said before, we're working hand in glove with founders. So if I look at Luxury Escapes, again, like we've been involved there for 4 years now. The business has gone from sort of break even 2 years ago to doing 60 million EBIT this year. And part of that is we'd like to take a little bit of credit for that in terms of like keeping CapEx down, like making sure that it's focused on the right expenditure as and when it occurs. But at the same point in time, we've picked a sector where we know there's going to be tailwinds coming out of COVID. Of people are going to want to travel. And even in environments like we're seeing today, like people still want to get out of Dodge every so often and go somewhere. So whilst passing through the Middle East might not be a great idea at the moment, there's still plenty of sales going on.
So anecdotally, we know now that many private companies are choosing to stay private for longer, Campbell, and not go to public markets. Can you talk us through the reasons for that or your views as to why that's the case? Obviously, it's different strokes for different folks, but...
Look, I think as a private company ourselves and you guys,
Yep.
there's significant advantages to being private as opposed to being listed. We
Yep.
we were listed. Pier12 was listed as a business, and we delisted this time last year or thereabouts. So I think from one is just the pure availability of capital. So if you look now at the industry funds and super funds and the like, they're allocating 20 to 30% to private markets. Now that includes private credit infrastructure, etc. But there's big chunks of capital that are allocated towards private markets. In the US, private equity is something like $5 trillion and has doubled over the last 10 years. My expectation is that'll happen again over the next 10 years. So if I'm sitting here with a CEO of a private company that needs to go out and access $100 million to grow, they can get a $1 billion valuation in the private markets, get two investors to put $50 million in that are going to be value add to their business. Why on earth would you want to list and sit through all those things we mentioned before around earnings calls? And I mean, it does take up a significant amount of time. It's sort of 30 to 35% of a CEO's time is dealing with public markets. So if that time can be better allocated growing the business, why wouldn't you do that? And I think the average investor can now also get access to private equity and private markets. So again, there's that advantage of still being able to get exposure to it. The companies and the sectors, I mean, we discussed it a bit earlier, but it's like the sectors that you can get access to in that private market space are probably broader and wider than what you can get, particularly on the ASX. Probably a little bit different on NYSE or NASDAQ. But certainly on ASX, there's not that broad brush exposure to space or AI or those kind of style of investments.
Yeah, it's interesting, is that only 2% of the world's companies are listed, 98%. And then you see the numbers around the numbers of companies that were listed on the stock exchange that are now listed on the stock exchange all sort of speaks to that. I guess moving to the investment selection, Campbell, when you're assessing an investment opportunity for Pier12, what are the things that you look for when deciding to invest in an attractive thing?
The most important part is really the founder. That's sort of the first go or no-go scenario, getting to know the founder, spending 6 to 12 months with the founder, having that relationship, if you like, to ensure that, one, you can get along with the person. It's reasonably important if you're going to sit on someone's board and be actively involved in their life. And a lot of the founders, these businesses are their lives. So we want to make sure that we're not intruding or just have a culture clash, I guess, if you like. And then we're really looking at sectors that we see have significant tailwinds. So we sort of start with the sector and then work down from there. If we can see that there's significant growth in the sector, that the business has a moat around it that protects it from competition, whether that's trademarks or the like, or they've just got a first mover advantage that puts them so far in advance of the next best product that's likely to come. There's no way of ensuring 100% that that's the case because the world is a very innovative place. But I think from the perspective of looking at that, and then also I guess who the co-investors are. Well, there's a list of 20 different things that we'll sort of go through as a starting point, and then as you continue to do due diligence, obviously other things sort of poke their heads up as you go through.
So the things that really separate a great private equity investment, Campbell, from one that you reject?
Again, it's the founder. What we've found is across the board, if you get a founder that is completely driven, completely focused, and has those other 2 or 3 boxes ticked that I said around a moat and the like, there's almost no stopping them. And in the US, we've got obviously some pretty amazing founders that have been there that have either served in the US military or have that singular sort of blinkered focus that stand them out from anyone else that we've sort of dealt with. So I think you can always pivot from a business perspective, but having a solid founder that has that capacity to continue to grow a great business is not as common as you would think.
No. No, certainly not. So you've recently started your US Opportunities Fund too, Campbell.
Yep.
Can you talk us through a couple of the investments that you've got in the portfolio and what you think makes them attractive businesses?
The US is obviously a very different market to Australia. The scalability of it, just the fact that there's 350 million people within and they're all a little bit different, obviously. The markets in the US. So if I look at two examples in particular, there's a company in there called de-ice, which if anyone's ever been flying through the Northern Hemisphere in the middle of winter, and we did it last week, and the plane's sitting there getting de-iced. This technology effectively, and it sounds relatively simple, but it's come out of MIT. The founder was literally sitting on the plane the same as we were a couple of weeks ago, sitting there thinking there must be a better way of doing this. He's gone away for the better part of 8 years. Come back and now pushing through FAA approval, and he's got a technology that basically is a strip that runs up and back the wings of the plane. Gets the electrons to basically bump into each other, which effectively heats up the wing of the plane. So instead of spraying glycol, which is carcinogenic and destroys the tarmac and is relatively expensive, this is a press the button, similar to what you have in the rear demister in your car.
Of course.
So that technology, if you think about the capacity of it, there's 10,000 planes in the US that fly through snowed-in areas. Each of those costs the airlines $1 million a year to basically de-ice with glycol, and that sort of only partly includes delays and the like. So to give you an example, FedEx over 2 weeks, it cost them $350 million because they weren't delivering parcels. So if you can remove that sort of bottleneck by having a literal press the button scenario, what are the airlines willing to pay for that? And de-ice has got contracts with Air Canada and working through a number of the other major airlines over there. So our expectation is that will continue to chug along relatively nicely. And then there's obviously there's drones, there's the wind turbines, those kind of things that
other
sort of are in relatively harsh areas. And the wind turbines literally snap if they get ice on them. So similar kind of scenarios that would branch out over time, but the market they've got at the moment is a multi-billion-dollar market, and they're a $100 million company. So excited about that one. Probably even more excited about a company called Encharge AI. Everyone has AI at the end of their name.
Yes, I know. Seems to be a trend. Not sure what that's about.
These guys actually do AI, so that helps the scenario. So Encharge AI has come out of Princeton University. The professor of engineering there has been there for the better part of sort of 20-odd years. Last 10 years, he's been working on an analog chip that basically, if you think about the issues in the data center and the issues on laptops doing AI, large language models and calculations and the like. So effectively on the laptop, there's only a certain amount of power that you can get out of a laptop. So what they've done by merging the analog and digital technology is basically decrease the power consumption by about a 1/20th of the original power requirement. So effectively what that does means you can do 80% of the compute at the source or at the edge, as they call it. And what that means is there's less latency because you're not sending it to the data center and getting it back again. More secure as well because it's sitting
doing more of it
on the laptop. And then if it needs to, there's a switch inside every computer that says, okay, this is too hard for me, send it to the data center. Effectively. So their next move on that is, okay, well, how do you get that into the data center and go, okay, how do we decrease the energy consumption within the data center by a similar amount? And there'll be more on that over the next couple of months, I would think.
Yeah, fascinating. They both sound like companies you'd find in some sort of futuristic novel, Campbell, but they obviously are around in what you were talking about before, that huge market of the US where these ideas are there and being implemented.
Yeah, and it is real world stuff. I mean, I think everyone's sitting there scared around what AI is going to do to the world. I think probably similarly to everyone was sitting there in the Industrial Revolution having the same conversations. Am I going to lose my job because this machine's going to go and do it? I think the world evolves and everyone finds their little way of continuing to be and continuing to earn and have a job and raise their families and all of those kind of things. So I think we're not scared about it. Quite the opposite. We're kind of embracing that technology and that capability. Things always get overhyped. We've seen that obviously with some of the prices that stocks are trading at or companies are being purchased at. I think that's maybe gone a little bit far, but at the same point in time, there's some amazing emerging technologies that are coming through.
Which is a perfect segue into the next question around overhyped. There seems to be a lot of money chasing private equity at the moment. Amber, was there anything that concerns you, or do you think there are things being overhyped at the moment in that space?
I think it's interesting. There's probably 2 or 3 different ways of answering that same question. If I look at Australia, I would say the big industry funds have got so much money that they almost don't know where to allocate it. So they're becoming private equity investors when they're actually just equity investors. And so they're taking public companies private, which is not a bad thing. As I said before, enables businesses to operate better and more efficiently.
We're seeing on this in the ASX with Cube at the moment. I think that's a good example.
So I think that's one side of it. If I look at more broadly, I would say that private equity is only just getting started. So quite the opposite of being overhyped. I think we're only just getting to that point where people like your clients, for example, are sitting there going, hang on a minute, maybe I do need an allocation to private equity because I'm missing out on certain sectors or I'm missing out on that extra 5% return for this part of my portfolio. So I think there's only going to be a broader allocation to private equity. As you rightly said, the issue is there too much money chasing the same things? But I think the way we've sort of done it is we're dealing directly with companies and being part of the growth and expansion of the pet stocks, the Luxes. And then in the US, there's absolutely more than enough capital to allocate to the opportunities that we're seeing over there. I mean, I think we could raise a $300 million fund and deploy it in a relatively quick period of time.
The myth or myths about private equity that frustrate you, Campbell? You're at a barbecue and someone says, I heard this about private equity. What are the things that frustrate you that people perceive about the asset class that are just wrong?
It's not so much the perception of the asset class, it's the way people try to pretend that there's liquidity attached to it.
Yes, okay.
My big bugbear is liquid alternatives. Because there's no such thing. It's
like having an oxymoron.
Like having a liquid house or a liquid property portfolio. It takes time to build businesses and it takes time to exit businesses. So my one caveat, I guess, is if you go into the asset class, you've got to be prepared to be there for 5 years. We are seeing a lot of groups provide liquidity, but what they're doing is basically sitting 20% of the allocation that you guys are making to private equity in cash. So you're giving up 20% of the excess return by having cash in the portfolio. Or some of the bigger guys, I guess, have the capacity to do it off balance sheet, but it's not true asset level liquidity. So that's probably my main bugbear. And there are groups that are doing it. I just don't think the two mix. And as we said very early on in the conversation, you're giving up liquidity to get the return.
Absolutely.
That's the way the asset class works.
The biggest risk that investors underestimate with private equity, Campbell, I think I know the answer to this one after we've been talking about liquidity, but if there's anything else you want to chime in about.
I think there is, and there has been, particularly in the last 5 years, call it that longevity risk of people going into an asset and then expecting for it to come out in year 5, and guess what? Public markets aren't there, so you can't list. There's not enough M&A activity to merge. And the 3 doors that I mentioned before are all kind of jammed shut.
Or you're being forced through the one door at a bad price.
Exactly. And so I think that's the biggest risk. I think we're starting to see M&A continue to, or slowly build.
Yep.
I think we're starting to see some floats. We managed to float Voyager Space Holdings midway through last year on the NYSE. So that was sort of a good sort of test case, I guess, if you like, because space is still one of the sort of frontier style technologies.
Yep.
I think that's the main risk. It's just a question of what markets look like when you're trying to get out of things.
Yep.
And that's the difficult sort of $20 million question.
Yep. Now, I think you're going to answer our final question like the quintessential stock picker, Campbell. Old habits die hard. Given the current economic climate, the geopolitical climate, the interest rate environment, how does that change your views of the opportunities in private equity today? You can't say they don't. You can say you don't.
Yeah, you had me already. No, look, it does. It does. I mean, I'm an economist at heart, right?
Good.
Like I look at the economy and I wouldn't be surprised in 3 hours' time if we're dealing with an interest rate rise. You have to factor in what's going on in the globe into everything that you do. I think, having just got back from the US, I think the US is still very heavily US focused.
Mm-hmm.
And so I don't think it changes it as much as what we sort of sit here in Australia getting tidbits of information that probably scare the public more than what it does in the US.
Yep.
But as I said before, it's like there's issues going on all around the world, but Luxury Escapes is still selling $4 million worth of sales a day.
Yep.
We've got businesses over in the US that are still winning contracts every day and building through. So to some extent, yes, you have to listen to the noise, but you have to work out what to ignore at the same point in time.
Yep.
I think
is it a noisier environment now than what it's been in the past in terms of the noise you have to digest? Yeah.
I think there's and most of it's rubbish.
Yeah, of course.
So
it doesn't make it any easier though, does it? Probably makes it harder.
Still got to ignore it. But I think without getting too political, our governments have spent way too much money.
Yep.
And that's driving inflation. Therefore, interest rates are going to go up once, twice or thrice.
Yep.
And that is going to have an impact on economic growth, which is then obviously going to have an impact on people's ability to spend on holidays, pets or kids.
Yep.
But at the same point in time, there's still enough velocity of capital out there that of people who do have the capability to spend that are going to drive earnings of these businesses. But you do listen.
Yep.
And hope sometimes you let it go in one ear and out the other.
Very quickly, yes. Good. Campbell, thank you so much for joining us today. We really appreciate hearing you talk about Pier 12 and private equity as an asset class.
Yeah, no, pleasure. Thank you.